Today on Small Cap Power Stock Brawl, we're talking about Dollarama, symbol DOL on the Toronto Stock Exchange. Is it a company you should buy, hold, or sell?
So Alex, I think Dollarama is a top-tier growth stock that will continue to impress investors. Looking at their sales growth over time, it's actually experienced a CAGR of 11% since 2011. Even more impressive has been their 6% same-store sales growth figure since the IPO in 2009.
The company has done a tremendous job over the past several years, but is the growth really sustainable?
One sort of figure that I've looked at is the price increases that Dollarama has been implementing. One might think to themselves, why should we shop at Dollarama, which is increasing their prices, compared to a Walmart down the street? A CIBC World Market Studies has found that there is a 40% price gap between Dollarama and the other discount stores on average.
That might be true, but the higher they raise the price at Dollarama, the more they start competing with the larger brands, just like you mentioned, and then the less of an incentive the consumers actually have for going to Dollarama. No doubt, Dollarama is one of the top tier Canadian stocks over the last couple of years or several years. But can the growth really be sustainable at that level? They have 1,100 stores going on forward for 2017, and they're planning to roll out maybe 1,400, cap it at that. So you're looking at maybe another 3 to 4 years of growth at those kind of levels.
A study has actually found that benchmarking the US's dollar store discount numbers in the US, where there's around 28,000, right? Taking that number and dividing it by the population, you will actually find that the amount of dollar stores in the Canadian market should be a lot higher than it is now.
So if you keep on rolling out the amount of stores that you're projecting, it's just going to create cannibalization factors within the stores.
I think the industry-leading profitability for the firm is impeccable. Nobody compares to their EBITDA margins, upwards of 20%. And they've been actually increasing their margins over time as well, which is a feat of its own, right?
Well, let's think of a different case scenario. Imagine Dollarama has a bad quarter. What do you think is going to happen to the share price and their valuation? It's going to go down. And which brings me to my next point. No matter how good the company is, it can make for a bad investment. And it will always come down to valuation. And that's one category where Dollarama just completely bombards any other valuation multiples we see in the industry. Almost 5 times sales, 21 times EBITDA, 33 times cash flow. Now, these multiples are higher than that of their closest competitors, and at the same time, they're higher than that of companies like Amazon. They're in line with companies like Netflix, Twitter, some of these large cap tech names.
Okay. You're certainly right. Valuation is an extremely important factor to take into account for investors. And although you mentioned some valuations where the stock does sort of appear to be overvalued.
Right.
One multiple that it certainly is not overvalued in is its earnings multiple.
Right.
Its PE multiple is at around 20 or so right now. And compared to its closest competitor down south, which has actually moved here, Dollar Tree, which is trading at around 51 times, the stock certainly doesn't seem overvalued.
You and I both know that PE multiples are a measure of the company's ability to grow in the future. Now, back in 2010, the company was trading at about 10 times earnings. Now, as you mentioned, it's upwards of 30. Back in the day, the growth opportunities were tremendous, as it only had maybe like 200 or 300 stores. Now, they have so much more stores, much less relative growth opportunity, but the valuations have almost doubled.
You might be right that back then, growth opportunities were robust. But I'm going to argue that the growth for Dollarama has just begun. Looking internationally, they've actually started to open up stores and make partnerships in El Salvador, in South and Central America.
But this was in 2013.
This was in 2013, right? And so they've been actually studying and studying the market there and seeing if it's actually feasible.
3 years later, it hasn't materialized.
Well, sure, 3 years later, it hasn't materialized, but I mean, it takes time to sort of study this market and see where it's going. Dollarama is relatively recession-proof. As income actually lowers and consumer debt levels increase, consumers are actually more inclined to shop at Dollarama.
Shareholders of Dollarama have profited quite a bit, and now that they're buying back their stock and paying out dividends. But I actually kind of question those corporate governance decisions, based on the fact that Dollarama itself has $1.1 billion in debt, and they're paying $27 million in interest a year. Why not just take that money that they're piling towards their shareholders and paying some of that debt off so that they never have to pay interest in the first place. Or if it's such a growth story, just reinvest it in their business.
Okay, well, Alex, first of all, incurring debt that Dollarama has, which by the way is nowhere near the amount that its competitors may have.
Hey, 27 million interest, that's something.
27 million interest, you're right. But you know what that interest actually does? That interest will lower the net income before taxes and will actually lower the taxes paid for the company. Leverage is actually needed in some companies to actually have these tax rates and actually improve earnings in a way. So it's not to say that they're foregoing paying off this interest and paying off their debt by making accretive moves like buying back their shares. But in fact, it's a strategic move to incur these tax breaks and ultimately increase earnings, which is any company's ultimate goal. Growth is robust. International opportunities continue to show itself, and although it hasn't materialized yet, I believe will so soon. Margins are industry leaders. And in terms of valuation, yes, some enterprise value multiples do seem kind of out of hand, but as they normalize and investors see the robust growth that they will continue to meet, I think their share price will continue to grow.
Okay, fair points. We'll see in a year what happens.
Yes, we will.
Thanks, guys. Make sure to vote below to see who won today's stock brawl.